the partner demands, they're open to consider that and are not, however, looking to exit the business completely. So that's an important guidance as well to watch out for. If the deal is tempting, promoters can also completely check out. So he's not closing down on any possibility at this point of time. But keeping it with Tata Steel for now, we have the management with us, Mr. TV Narendran, who's patiently waiting by. Let's take it across to him. So, while the rubber prices were okay in the quarter gone by, internationally the prices have dipped October onwards. Is that what you're witnessing, and what could be the reason for the same, if you could tell our viewers? And where do you see steel prices move going forward amid all the worries regarding slowdown seen in Chinese markets?
So you're right. I think we've had a 3,500 crore impact on the debt because of the translation of our overseas debt. It does impact us in raw material prices in terms of the coking coal that we buy. We buy 70% of our coking coal from overseas. So it does have an impact. But overall, when you look at it from a Tata Steel perspective, a weaker rupee is net positive for us because it gives us stability in the market, and which allows us to absorb the increased cost because of the impact of the rupee on the coal prices. So net, we typically are better off in a weaker rupee. It also makes us competitive on dollar terms. You know, this is exactly what happened to Russia 3-4 years back when the ruble dropped significantly. The Russian steel makers became very competitive because most of their costs were ruble costs, and converted into dollars it looked good. So in some sense in India, when the rupee depreciates, a lot of our costs which are in rupees look good in dollars, and that helps the competitiveness of the industry.
So Bhushan Steel contributed well to the overall numbers. Do you believe that they have been able to weed out the inefficiencies in the plant? Is it lagging the India EBITDA per ton, which still on 19,000 per ton? Do you believe that you'll still be able to add on to synergies coming from that acquisition?
So the gap will be bridged fully because the standalone India numbers, if you take out Bhushan Steel, which is at 19,000, is also helped by the fact that for Jamshedpur and Kalinganagar, 100% of the iron ore is our own iron ore, and 30% of the coal is our own coal. As far as Bhushan Steel is concerned, hardly any iron ore is our own iron ore. In fact, we've just started some supplies to Bhushan Steel, but it's not that we have so much iron ore just now to take care of all of Bhushan Steel's needs, and the coal is 100% bought out. So it's a very different dynamic for Bhushan Steel. So our first objective is to see that the Bhushan Steel EBITDA matches the EBITDA delivered by some of our peers in the industry who also buy raw materials, and then to see what better we can do, because obviously there is a lot of work going on the synergy side. Bhushan Steel will derive the benefit of plugging into Tata Steel's global coal procurement. Bhushan Steel will derive benefit from cross-benchmarking with the Tata Steel plants and improving the KPIs of most of the facilities. So there are a number of initiatives happening on the procurement side, in the operation side, in the maintenance side, and in the marketing and sales side, which will help us continue to improve the numbers in Bhushan Steel, but it will certainly not match what has been achieved by Tata Steel in Jamshedpur and Kalinganagar.
So you've also acquired Usha Martin, which is a big boost to your long products portfolio. What's the logic of acquiring it via Tata Sponge, if you could help us understand that, and how will Tata Sponge fund this acquisition, and how will Tata Steel support this whole process?
So if you look at our configuration in India today, we have three big sites in Jamshedpur, Kalinganagar and Angul. So with these three sites, Angul is a Bhushan Steel site. With these three sites, we have the potential to grow a flat products business, which typically is an integrated steel plant kind of structure. And with these three sites, with the land that we have in these sites, if we have the appetite and the capital, we can certainly build about 30-35 million tons of capacity in these three sites. In long products, we believe that the growth can come through a different model. It could be a distributed production model. It's a different cost structure for long products businesses as compared to flat products businesses. It doesn't necessarily have to be integrated steel plants, and you can have far more optimal use of land in terms of smaller facilities distributed closer to markets. So the whole configuration of long products could be very different. So that's why we decided that our long products ambitions are better fulfilled through some of our subsidiary companies. Tata Sponge was already looking at going downstream into long products, and so we said instead of building new capacities, we can use Tata Sponge as a vehicle to acquire Usha Martin, and this could be the nucleus of emerging long products business for Tata Steel, where we will look at any other long products assets which may come in our line of sight, and develop a structure which is slightly different from the Tata Steel flat products structure. So that is a strategic logic of doing it through Usha Martin, and Usha Martin obviously would need support. The board of Usha Martin is discussing it, and they have already mentioned that there will probably be a rights issue, and Tata Steel will be very supportive of that.
Now with your JV with the Thyssen Group coming under the EU radar, how would you convince them that the JV is not against the merger regulation and it's competitive in nature?
Ask us questions, we expected them to do that, and I think that's the process in Europe which we have to follow. So we went through phase 1 where we submitted, we put in our submissions, and we were expecting that it would go to phase 2, which is what has happened. So EU has asked us some questions on packaging steels, because between Thyssen Group and Tata Steel in Europe, we become fairly strong in packaging steels. The EU has asked us some questions on electrical steels, and the EU has asked us some questions on automotive steels. So we will be addressing the concerns, we will be engaging with them, we will support them in the investigations, and they've given themselves 90 working days, and we will go through the process. Fundamentally, our argument is that in today's day and age, when you have fairly open markets and material flowing everywhere, you need to be structurally strong in whichever geography you're in. So in India, we are privileged to be structurally strong and we can grow and take care of ourselves. But in Europe, I think the industry is operating in a mature market, the demand is not growing. So there needs to be greater structural strength in the European industry, and I think Arcelor and Ilva coming together.
All right, sir. All the very best for all of the endeavors that you're planning to undertake in the coming few quarters and months. Let's move right on and focus in on another stock that's buzzing away, of course, on the downside, which is Skipper. The numbers were fairly disappointing in the quarter gone by. Let's understand what transpired in Q2 straight from the management itself. We have Devesh Bansal.